There it is.
So it must have been just started then.
Again, welcome everybody. I'm Nancy Weiss, President of the Michigan Canyon Association. We're excited tonight to have a presentation from the California Department of Insurance. We've got Rob Obedoza with us tonight. I wanted to mention before I more formally introduce Rob that this is an issue that MCA has been tracking for a number of years. Certainly, since the Hasacita fire affected us, but also markedly for me, in my opinion, since the Thomas fire, when we saw an additional escalation of rates and a lot of just canceling whole zip codes and other challenges. We've tried to mitigate that some by working closely with Senator Monique Limon, then Assemblywoman, and we did participate with Commissioner Lara at a meeting that was held in Montecito just after the Thomas fire, which was super helpful. And I appreciated the commissioner coming down. And then through Firewise communities, which are now allowing enabling us not only to be formally recognized for the community organizing we do, to take responsibility to make our own communities safe, to do brush clearing and home hardening and all that, but also to qualify for a discount, albeit not a lot so far, maybe 5-10% from some insurers on our fire insurance, including the FAIR plan. So with that, welcome again. And Rob, we really appreciate you being here. And Rob, I think I understand you do a lot of these community outreach programs. And really our interest tonight is to have an update about particularly fire insurance, since that, I suppose, fire, flood, are important. Debris flows, of course, have been an issue in our county here. But also allow folks to maybe have some time to ask you some questions. We certainly get a lot of questions at MCA, so thank you again for being with us tonight.
Yeah, of course. Thank you for having me, Nancy, and thank you for inviting me. So just let me go ahead and share. So, just a quick introduction. My name is Rob Obedoza. I am the outreach analyst for the Department of Insurance for Los Angeles, Ventura, and Santa Barbara County. And I'm here to present today on kind of the state of the current
You want me to
insurance
send it to
market.
the
Um, on the state of the current insurance market, how we got here, provide you with some statistics of what we've been finding in these past couple of years as far as moving in the insurance market, and also talk to you about some of the changes that are coming in pretty soon by the end of this month, to tell you the truth, that are going to hopefully alleviate some of that pressure, provide more insurance options, and hopefully get those costs down in the near future. So, real quick, let's talk about how we got here in the current insurance market. So, numerous different factors have contributed to us to where we're at in today's insurance market. One of the primary things being inflation, creating unprecedented financial stress to insurance markets globally. In addition to that, increased costs of rebuilding supplies, materials, auto parts, and things like that. Among other costs, are affecting these insurance markets. Reinsurance, which is a problem for insurance companies. So, for those who aren't aware, reinsurance is basically insurance for the insurance companies. So, to help safeguard themselves against the policies and liabilities that they've got to pay out should a disaster or catastrophe happen. Those insurance companies are finding reinsurance to be harder to find and more expensive. And with that being more expensive, they're passing those costs along to the consumers. And as risk grows, insurance markets are contracting to either protect solvency, to meet their financial obligations and regulatory mandates. So we're seeing these companies stop writing new policies altogether in certain areas, or even pulling out in California, as you've heard in some companies' states or in some companies' cases, where they're no longer writing policies at all in California due to the current insurance market conditions. In addition to that, natural disasters and global inflation have increased insured losses and costs worldwide like never before. So that's kind of like how things have gotten to this place in the global market. Let's start focusing and drill down to the California market. So within California, the top 12 companies, which are typically the insurance companies that you've heard of, the State Farms, the Allstates, the Farmers, and so forth, those top 12 companies write 85% of the state's homeowners insurance market. And since 2022 alone, 7 of those top 12 insurance companies have either paused or restricted new business despite rate increases approved or pending with the Department of Insurance. So, this table shows a little bit of those statistics as far as those top 12 companies. You can see State Farms, Farmers, Liberty Mutual, Mercury, the ones that you see on commercials all the time. You can see that market share that they control or write policies for within the state of California. And you can see those pending rate increases since 2023. So you can see each of these companies have been asking for increased rates, which are either approved or are going to be approved, depending on the rate approval process by the state of California. But even with those rate increases, we're still finding these we're still finding these companies stopping writing policies or limiting new policies altogether. So you can see in State Farm, this is kind of the biggest one of the biggest companies is the biggest company doing this. You know, they've been in the news a lot in California where they've paused new policies. They're not writing new policies for homeowners. In fact, they've pulled out of I think earlier this year there was a whole list of zip codes and cancellations that and numbers that they produce, canceling thousands of homeowners insurance policies across the state. You can see companies like USAA, they've restricted underwriting to only low risk properties, and some of these other companies, they're still taking policies, but they're just limiting new policies to help protect the policies that they currently are underwriting for. So a little further context, in the past 10 years, homeowners insurance companies have done far worse in California than nationally. And one of the biggest reasons for that is because in the past 10 years, as Nancy had mentioned at the top, California has suffered some of its most devastating wildfires in the state's history. And that has amounted to massive losses across the insurance companies, insurance market within the state of California. So by any metric, whether it's incurred loss ratios, underwriting profit, or return on net worth, insurance companies are doing a lot worse in California than they are nationally. But I will say, as far as as insurance rates and percentages goes, California is still kind of middle in the pack as far as what percentage of rate increases are going through. We're still a lot better than, a lot of other states like Texas and Florida, where the insurance rates are getting out of control as well. So we're kind of in the middle of the pack rate wise, but they're still taking heavy losses in California. So, oh, do you mind if I stop this real quick? I think I'm sharing the wrong presentation because I wanted to add some additional California or Santa Barbara impact. So give me 1 second. Okay, this should be all right. Okay, so I wanted to get to these slides. So last month, actually, at the Santa Barbara Public Library, I was presenting at a town hall with the Santa Barbara Association of Realtors, and their deputy chief economist, Oscar Way, had provided a lot of great details and statistics about the Santa Barbara region, in particular, the zip codes that you all folks are residing in, and you can see, just wanted to provide some of these statistics for Santa Barbara. You can see non-renewals per 100, especially in the 93105 zip code, is about 7 per 100. And the total non-renewed in the past few years, has been about 408 residential properties. Premiums are also relatively high in Santa Barbara as opposed to the rest of the state. You can see how these premiums have increased over time. 93105 is about $3,112 on average. Your neighbors over there, 93108, they're about $9,060 per year on average. It's pretty high. Also, premiums will likely continue increasing in Santa Barbara as well. So I believe this is over the past year or so, in 93105, the average premium increase for State Farm was about 23.4%, and all states approved increases is looking at about 52%. So these rates are still continuing to increase despite some of the efforts of the Department of Insurance. Also, one big proponent of where we've gotten to this insurance market is we're seeing more and more homeowners switch over to the fair plan because as insurance companies pull out of certain areas or refuse to write policies in certain areas, more and more people are using the fair plan for their wildfire insurance. And a growing fair plan is not something we want in California because the fair plan is typically only or is intended for super high risk properties that cannot find homeowners insurance anywhere. They're being denied coverage, can't find a company to write those policies, or so forth. But we're finding more and more homeowners, even not in high wildfire risk areas, being unable to get wildfire insurance policies because, like I said, these companies are not writing in certain areas. So they're turning to the fair plan more and more. Average consumers are turning to the fair plan, and a growing fair plan is kind of a key indicator um, of a of a kind of dangerous insurance market because that fair plan is actually there's a misconception about the fair plan that the state of California runs the fair plan, where actually in actuality the fair plan is run by a pool of assets by the largest insurance companies within the state of California. So as more and more high risk properties start getting policies in the fair plan, if there was a catastrophic disaster, if there was another huge wildfire in one of those high concentration areas of the fair plan could suffer huge risks or huge losses. And as I'd mentioned, since the fair plan is actually funded by the pool of the largest insurance companies in California, those insurance companies would also be on hook for those fair plan losses, which further exacerbates the problems in the insurance market. So as I mentioned, the fair plan increase has increased to 3%, and actually it's increased to about 4% of the California market, becoming the insurer of first resort and not last resort for many. The credit rating agency AM Best has downgraded outlooks for the top 12 companies like State Farm, AAA, Mercury, and so forth due to risk concentration in California. Insurance companies will not write in high risk areas unless they can cover 100% of consumer claims. Now, keep in mind that unlike public utilities, uh, California's or insurance companies are not required to write policies at all in the state of California. We can't force them to write policies no matter what we do. It's really up to them if they feel like the risk is appropriate enough for them to write those policies in those areas. But we'll talk about some changes later on that are going to help out these insurance companies stay in California and continue writing policies as well. In addition to that, rate filings are more complex and can take longer than 6 months to review. We mentioned earlier that insurance companies have been asking for rate increases, and everyone's been seeing that when they're paying their insurance policies. But oftentimes, these rate filings can take 6 months, a year, 18 months to review because California, under Prop 103, is one of the only states that has what's called an intervener process, where outside entities or third parties can appeal rate increases that are filed by insurance companies and put that up to public review. And that can delay the increase in rates and that these insurance companies are asking for. And by the time those rates get approved a year or a year and a half later, then the insurance companies are playing catch up with that data, have to refile again based on new data, and the cycle continues. So we recognize Commissioner Ricardo Lara has recognized that all these issues and all these indicators has led us to where we are at this insurance market today. So he's started taking steps with this sustainable insurance strategy to hopefully provide more accessible insurance for California's consumers, bring those prices down, and also protect California's consumers from climate change. So one of the very first things, I believe this went into place last year in 2023, to kind of attack the root cause of some of these insurance issues by the insurance companies, which is specifically wildfire risk, is the commissioner introduced what's called the Safer from Wildfires framework. Now, for those of you in Firewise communities or have gone to meetings with like your Firewise councils or fire safe councils or fire departments, you may have heard of this. There's a certain number of steps and things you can do to your home or property to reduce that risk and mitigate that wildfire risk with your home, within your home, your surrounding area, and within your whole community. So the first step of protecting your home or business is having things like a Class A fire rated roof, having a 5 foot ember resistant zone around the structure. I believe they often call this zone zero, which is the immediate surroundings of your property. You're supposed to have non-combustible 6 inches at the bottom of your walls, ember and fire resistant vents, double pane windows or added shutters, and enclosed eaves. Now, you also, once you've protected your immediate structure, then we expand out to your immediate surroundings, where for to reduce the risk of wildfire, we're asking to clear vegetation and debris from under your decks, move sheds and outbuildings at least 30 feet away, and trim trees and remove brush in compliance with local, state, and local defensible space laws. And lastly, the third step of these Safer from Wildfires frameworks is protecting the whole community. So I believe Nancy mentioned at the top about being part of a Firewise community. Neighborhoods as small as 4 homes to hundreds of homes can form a Firewise USA community. If you go on the Firewise USA website, you'll see that there are certain steps that you just need to take, certain paperwork you need to file, doing things like a risk mitigation or risk assessment for your community and be able to get that that safer or that Firewise USA designation. Also, another one that's recognized is the fire risk reduction community. Whichever community you're a part of, it's all about community mitigation because, as you're probably aware, you can do everything you can with your home to protect your home from wildfires and going up in flames. But if your neighbor is not doing anything to help that cause, then your home can easily catch fire, and so can the rest of your neighborhood. So it's really important to work together as a community for this wildfire mitigation. So much, in fact, that I believe I was at the presentation with the Santa Barbara Association of Realtors last month. They had mentioned that if a home or community is doing every one of these steps for the Safer from Wildfires framework, this can reduce your wildfire risk by up to 70% in total. So it's definitely something to look out for, and insurance companies are taking notice. As Nancy had mentioned at the top, that since the Safer from Wildfires framework has been introduced, that doing these steps towards wildfire mitigation can carry certain discounts with your insurance carrier on your wildfire insurance policy. For example, the FAIR plan, I believe just by simply being part of a Firewise community, they're offering a 10% discount, um, but additional discounts for doing each one of those 10 steps of being a part of that fire or of those Safer from Wildfires framework. And as part of the rate filing process with the California Department of Insurance, when insurance companies file their paperwork to either raise rates or adjust rates, they have to take those Safer from Wildfires risk mitigations into account and also provide discounts on those steps that have been taken. And you don't have to do everything to get a discount. Just by doing simply one or two of those steps should entitle you to some type of discount with your insurance carrier. We would recommend talking to your insurance provider and asking what discounts are available and how much that could be. But also, it's kind of like a cost benefit analysis as well, because as Nancy had mentioned at the top, sure, you're going to get a discount from your insurance company, but that may not be much of a discount. Like I said, 10%, 15% off your wildfire insurance, but some of those mitigation efforts can be quite expensive. So, you've got to decide if that's going to be worth it or not. But complying with those Safer from Wildfires regulations, which we'll talk about later on, can also help when insurance companies are assessing homes for if they're going to write those policies for those homes, they will be taking that into account with some of these new regulations that they're coming into place. So we'll talk about that later on. In addition to that, the California Fair Plan is currently offering $20 million coverage per location for commercial properties, including HOAs. I believe for residential properties, it's about like 3 million or 3.5 million, I believe as well. Along with the Safer from Wildfires regulation, we also provide some transparency with how insurance companies assess your wildfire risk. So, with these Safer from Wildfires regulations, your insurance companies are actually required to provide you with what's called your wildfire risk score, which is kind of like your credit score. So, these wildfire risk scores are what your insurance companies use to determine your wildfire risk for your specific property, and they assign a score for each property or business that they cover. And if you want to find out how they're rating your property, and maybe find out what steps you can do to mitigate that and improve that risk score. Those insurance companies are required to give you that information under 4 different scenarios. So for one is when you're applying for a new wildfire policy, they're required to give you that wildfire risk score. 2 is when you've received a cancellation or a non-renewal notice, then they're also supposed to required to give you that wildfire risk score. When you're up for renewal, they're also required to give you that wildfire risk score. And if you've done some home mitigation and made some improvements on your property and you want to get a reassessment, you can also request that wildfire risk score. Now, in some of these meetings, I've heard from people say, I talked to my insurance company and they mentioned that, and I asked about that wildfire risk score, but they mentioned that they can't give that information out. It's proprietary. They're not allowed to give that out. That's not the case. So if they are an admitted insurance carrier within the state of California, which most of the common big names are, they are required under the Safer from Wildfires regulations to give that information. So if they're kind of fighting you on that or giving you some pushback, give us a call at the Department of Insurance and we can contact your insurance company on your behalf. Now, let's take a look at some of the changes that are actually going to be finalized within this next month to help modernize our insurance market and hopefully alleviate some of the pressure that homeowners are facing with the current insurance market. So, what Commissioner Ricardo Lara introduced a few years ago is what's called the Sustainable Insurance Strategy, aiming to provide accessible insurance for Californians and providing insurance options again for Californians across the whole state. And we want to keep it that way by creating a resilient insurance market while also protecting communities from climate change and reducing and mitigating that wildfire risk. So, some of these regulations that are on track to be finalized by December 31st, at the end of this year, at the end of this month, that the commissioner has committed to finalizing. Some of these changes include the biggest one, CAT models or catastrophe modeling and risk mitigation. So, catastrophe modeling has to do with how insurance companies are currently assessing risk and future losses within the state of California. Right now, California is only one of a couple states, I believe, that still uses what are called historical models, where insurance companies will take a look at the past 10 years of losses and risk and assume that's going to keep happening again and again in the future. And as I mentioned earlier, that California in the past 10 years has had some of the most devastating wildfires in the state's history. So they're going to keep assuming that's going to keep happening again and again and again. However, with catastrophe modeling, this is more an update, forward-looking, data-driven approach where insurance companies will now be able to take into account the risk mitigation that homeowners are taking into account, that the community efforts have been taken into account with FireWise, fire safe councils, fire risk reduction communities, and fuel reduction across the state, and factor that into the rate making process. And as I mentioned earlier, that those who are, and there will also be taken into account those who have been complying with those Safer from Wildfires regulation and prioritizing those homes when the insurance market opens back up. So for those of you who may be on the FAIR plan, if you have been complying with those Safer from Wildfires regulations and done that home mitigation, you're going to be giving first priority back in the open insurance market with those insurance companies who are committing to increase their market share, which we'll talk about in just a second. Now, we're also exploring what's called California-only reinsurance costs. So I mentioned at the top of the presentation that reinsurance is like insurance for the insurance companies, and it's getting more expensive as global catastrophes, global warming, natural disasters increase worldwide. However, we are looking to finalize California-only reinsurance costs, protecting consumers from paying for global catastrophes. So rather than the cost of hurricanes in Florida, wildfires in Texas, floods globally being passed on to the California consumers, we're finalizing California-only reinsurance costs, so consumers in California are only paying for the risk within the state of California. We're also looking at modernizing the FAIR plan. So although the goal is to move move more and more homeowners off of the fair plan and back into the open insurance market, we still want to make the fair plan viable for those who still don't have any other options due to high risk. And the fair plan is looking at expanding commercial coverage limits to 20 million per structure, which closes coverage gaps for HOAs, affordable housings, and infill developments. We're also looking at increasing transparency and reporting and customer service, frankly, with the Fair Plan, who, as a company, they were not really prepared for the huge influx of Fair Plan policies in the last few years. They're catching up to that, but we want to help improve their response time, improve their quotes, and make sure that they're providing the best customer service that they can. Um, Also, part of the sustainable insurance strategy is increasing insurance availability in at-risk areas. So, in order for these companies across the state, including the state farms, farmers, and Allstate, in order for them to be able to use these tools like catastrophe modeling, California only reinsurance costs, and so forth, we are requiring insurance companies to write no less than 85% of the homes and businesses in distressed areas as identified by the insurance commissioner. Um, this includes risks that are super high risk fire areas, which includes high concentration of the fair plan and other high risk areas across the state. These insurance companies have to commit to no less than 85% of the insurance policies in those homes. And for those companies that maybe have a lot smaller business, California has hundreds of insurance companies writing policies in the state of California's, and it may not be realistic for a lot of these smaller companies to increase their market share to that percentage. So we're looking at least in an average growth of 5% annually by those smaller insurance companies to bridge the gap between what those large insurance companies can provide. And as I mentioned, our priority is returning fair plan policyholders to the open insurance market. First priority is given to homes and businesses following safer from wildfires regulation. So if you've done that home mitigation, if you are a part of the Firewise communities, those of you on the fair plan will be given first priority back into the open insurance market. Now, in total, these regulations and changes, as I mentioned, they are aiming to be finalized December 31st, 2024, with these going into effect January 1st, 2025. And frankly, it's not as if these insurance companies are waiting until January 1st to start working on these things. We've been in contact and communication with these insurance companies working on these regulations, and they know these changes are coming about, so they've already started doing the work to get these changes in place. And we've already seen movement in the insurance market with some of the largest companies in the state of California. Allstate, for example, they've gone on record earlier this year stating that if these regulations in the sustainable insurance strategy were in place today, the very next day they would start opening up their insurance market across the whole state. The very next day, if they could. So once these regulations are finalized, they are willing to write new policies across the entire state. Other insurance carriers that we see moving on is so one of the companies that did not, or that stated they're pulling out from California altogether, a smaller company, was called Tokyo Marine. I believe they were canceling maybe 15,000 policies in the state of California. They announced that earlier this year. That same day, we got a call from Farmers Insurance, or no, not Farmers, Mercury. Mercury Insurance stating that, we know these regulations are coming down the road. We know these changes are something that we've been asking for. We will go ahead and transition those policies that have been canceled by Tokyo Marine into our business because we know these changes are coming into the way. And realistically, the commissioner has gone on record saying by the middle of 2025, we expect the insurance market to open. You expect to see movement in the insurance market opening back up and seeing those options available again. So you can start shopping around and have more options rather than being relegated to the fair plan. And these insurance reforms are the largest insurance reforms since voters passed Prop 103 in 1988. So the California Department of Insurance and the Insurance Commissioner operates under those regulations passed by California consumers under Prop 103. And we still got to operate under that, but we are looking to modernize that with some of these changes that, frankly, should have been implemented a while ago. As you know, when Prop 103 was voted in the past, the insurance market and the markets in general in 1988 have changed a lot since then. And Commissioner Lara and myself included in the Department of Outreach, Insurance Outreach teams, we've met with more than 122,000 consumers in person and virtually since 2019. We've held numerous meetings, town halls, events in every county within the state of California. And a lot of these changes are based on the feedback that we've met from communities such as yourselves, from farmers, from insurance companies, from legislators, to make sure that we can alleviate some of the pressure with this insurance market and make sure those changes stick, and provide a sustainable insurance market with California down the road. I will also mention that um, w- before these regulations are finalized on December 31st, 2024, there is actually one more public hearing for public input this Thursday, in fact, on December 5th, for reinsurance, for California only reinsurance costs. I'm linking in the chat a link to that press release, and there should be a link there for registering for that Zoom public hearing. And we invite you and the public to listen in, to provide public input, read through the regulations, because, like I said, a lot of these changes are based on what consumers such as yourselves feel about some of these changes in the current insurance market. So we'd love to hear from you. Definitely go on public, get that on record about some of the changes, how you feel about that. We value your public input and invite you to participate. Um, and these changes are big. They're coming really soon in December 31st, 2024. But that's not the only thing that we do at the Department of Insurance. We are also your consumer advocate for the insurance companies within the state of California. So if you're having any issues with your insurance company, let's say they're giving you trouble when you're looking to file a claim, or not paying you enough value for your property, or like I said earlier, not refusing to give you that wildfire risk score, give us a call. Let us know what the situation is. We can go over your insurance policy, contact your insurance company on your behalf, get a response from them, and maybe mediate between you and your insurance company. So, change is on the way, help is on the way. It's going to take some time, but with these changes, we're looking to see at least some movement within the insurance market and some relief within this next year. So that's everything that I have. Thank you for listening to this presentation. Thank you for your time. I will stick around to answer any questions that you may have.
Great. Thank you so much, Rob. I appreciate the historical perspective, as well as a vote for some of the things that we can take action on. And I do want to note that we have folks from the Fire Safe Council here.
Oh,
Kate is here. She put in the chat. She's available to help folks form Firewise communities. I think in Mission Canyon we have 4 or 5 now,
oh, good.
including Upper Tunnel Road, Upper Mission Canyon Road, and others. But we really are promoting folks to do that. And Rob, you saying that those of us who meet the kind of intent or the requirements of the Safer from Wildfires laws, which includes home hardening and Firewise community, like taking those actions ourselves, that we'd be perhaps, I'm hopeful when I hear you say that, allowed back into the regular market off a fair plan. That would be a nice change because a lot of us just got summarily canceled,
Yeah.
and some of us tried to fight it, and got a little bit of a break for a year or not. And then, of course, the prices have been really skyrocketing. So thanks to Kate for being here. Um, we really wanted to make sure, Rob and I worked together and make sure that we'd have at least a half an hour for a Q&A. My request would be either a raise hand or go ahead and put your question into the chat, and we'll just tick through them. If we don't get through them all, I'll make sure to put my, Rob, either you can decide whether you want to put your email in there, or if you prefer, I can put mine in there. People can email questions and I can aggregate them and then send those to Rob, and then we can maybe post those on the website or figure out a way to kind of get people's questions answered in the future.
I think that
those
would be the best. Yeah, if you could like compile a list and send them to me and I can provide a response. And yeah, you can post it on the website for everyone to view, like along with the
something
video.
like that would be
Yeah.
great. Super. You have a thanks in the chat already.
Thank you, Selden.
Any questions? What are folks' questions? Touch.
Hi, Rob. Thanks for doing the presentation and showing up and all the great work you guys are doing over there. Primarily, I mean, obviously, I'm not sure you know, but Michigan Canyon Association was largely formed around our concern for fire safety, and working with Firewise has been a real positive. A real concern is while a lot of those other companies are going to be reinsuring some of the places that have been kind of the large swath uninsured. The real concern is, and from what I'm hearing, is that there may be some redrawing of the maps. What kind of progress can you talk about as far as that is going in instead of just going, okay, all of this area is, fair plan now. There is no other, because there really is no other option for 99% of Mission Canyon, or anything above Foothill, anything above Cathedral Oaks, anything above East Valley Road. Is there any movement to go in and kind of pinpoint, look at homes more on an individual basis or in certain areas that maybe aren't as big of a risk so that we can have some sort of benefit for, the fire hardening we're doing to our home rather than being like, okay, we're in this area, we all of a sudden are out.
Oh yeah, that's a great question. So from what I understand, as far as the priorities for those where those companies have to write that 85% of increase their market share to 85% in high risk areas, I believe it's like a three-step approach. So it's not just like determining by zip code or determining by fair plan. So there's a few things. I'm trying to find it. Hold on. Yeah, so it looks like here, let me share my screen actually. This might be helpful. So this was a presentation that we provided I think earlier this year about how those risk areas are going to be determined. So it's going to be a three-step approach. So zip codes with greater than 15% fair plan policies or affordability index. In this case, minimum of 85% policies written by the insurance market, and those smaller companies will have 5% of growth in their writing. We're
Rob,
also going to
I don't think we're seeing
We're
what
seeing the
you're
right thing.
hoping
Oh, I
that
am
we're
sharing the
seeing.
wrong screen. You're right. You're right. Here, I am like I'm on double screens. You guys probably saw like my email and stuff. Okay. So first approach, zip codes with greater than 15% of the fair plan policies or affordability index. Those areas, they're going to have 85% of the policies written by the traditional market, and those smaller companies are going to increase by 5% of growth. We're also going to take a look at counties with greater than 20% of properties at risk. So I'm not exactly sure how they're going to determine at risk. I think it's a combination of the catastrophe modeling that they're going to be using, plus I think it's Cal Fire Maps as well. So in those counties with greater than 20% of properties at risk, minimum 85% policies written in the traditional market, and 5% growth by those smaller companies. And then the third approach is also taking a look at those who are covered by fair plan policies statewide in wildfire risk. And those are going to be taken at 5% growth of writing to take policies out of the fair plans. So yeah, I mean, it's not a one size fits all kind of approach to determining which homes, but I mean, frankly, there's still going to be a lot of homes left out of those three approaches. But what the goal is with those catastrophe modeling, what the goal is with that catastrophe modeling is what you had mentioned, rather than determining from wildfire risk from state to, or from not state to state, rather than determining wildfire risk from zip code to zip code, especially where maybe half of the zip code is super wildfire risk and the other half isn't, for a lot of cases like that. Catastrophe modeling allows insurance companies to view individual properties and assess wildfire risk and mitigation within each property, um, as opposed to huge swaths of zip codes. So I'm not sure if that answers your question, but as far as identifying which are the high risk, they're going to take a three-step approach. But also, insurance companies will be able to look property by property rather than by zip code to determine that wildfire risk.
Awesome. I appreciate that. That really did cover it. As a follow-up question, real quick, there was from what I've heard from the insurance companies, well, their justification of pulling out was that the California Insurance Commissioner was not allowing many of them to raise their rates a certain percentage. Is there some truth to that? And if so, will they be allowing them? Because it seems like most all of us up here are stuck with the FAIR plan.
Mm.
Is there a truth to that, or is there how does that work?
So it's not that the commissioner won't allow them to raise the rates to where they want. It's more that there's restrictions under Prop 103 and how much insurance companies can raise those rates. And this is also one of the problems that I mentioned earlier is that so under Prop 103, insurance companies can ask up to a 7% increase in rate filings without having to go to a public hearing or up to public review. So in the past, insurance companies would ask for a 7% increase. Um, Once that's approved, the very next day they come back and file for a 7% increase and just keep doing it and doing that. But as you mentioned, if companies wanted to raise rates to the amount that they want to, it's going to exceed that 7% threshold. And that's when those insurance rates are up for public review. And as I mentioned, there's when those insurance rates are up for public review, then that's where California has that unique intervener process where third parties such as Consumer Watchdog, they can say they can appeal those rates and delay those rate filings process while that goes under review. And I've talked to actually just a couple weeks ago in a community, I talked to a retired State Farm underwriter who said that was one of the biggest problems is that they would file for rate increases, but then third parties would object to those increases, have those reviews drawn out. A year or two later, those rates finally get approved, and then by that time, that data is already 1 or 2 years old, and those insurance companies have to apply for rates again and change based on the new risk. So yeah, I mean, it's not that the commissioner isn't allowing them; it's the restrictions under Prop 103 that is restricting insurance companies from raising the rates to where they want. And that was kind of the original goal of Prop 103 is to protect California's consumers from undue increases and price gouging by the insurance companies. But then on the flip side, it doesn't allow insurance companies to properly price products without going through that review. So yeah, I mean, it's not really up to the commissioner. This is kind of how Prop 103 works.
It's yeah, just sorry, my last thing. But it seems like most of our all of our fire insurances have doubled, tripled, quadrupled. So it's not even like even that seven, if it was 10 or 20%, okay, but now it's,
No, yeah.
so
Yeah,
it's
yeah.
kind of failed. I guess the 103 overregulated and we all kind of lost out. So
Yeah, I
yeah,
mean
I'll open it up to other people. I don't mean to dominate this, but go ahead with
no,
it.
for sure. No, thank you for your question, for sure.
Selden had a question a little bit more about the dynamics of the rules of insurance discounts. It's in the chat here. In exchange for residents accomplishing mitigation measures. There's a lot of confusion, it seems like. So you talked about maybe formalizing a set of rules about what kind of discount will be given. Is that, will there be more specifics to that? I think is his question.
So as far as the discounts go, if the insurance carrier is an admitted carrier in California, meaning they are following the regulations of Prop 103, when they file for rate increases or file for rate approvals, built into that rate approval process, those companies are required to give those discounts for those safer from wildfires regulations. I'm not sure if it defines exactly how much of a discount they're supposed to provide. I think it kind of varies from company to company, but it is formalized that they are required to give those discounts. But I'm not 100% sure if it's finalized or formalized how much of a discount because it does vary from company to company.
Selden, did that answer your question?
Yes and no. And maybe, Rob, the ability to answer that is a little bit beyond what we know now, but I was looking for something more hard. Like, okay, if you achieve full compliance with the zero zone, then insurance companies would need to give a discount of a minimum of 10%. And once the homeowner has informed of his insurance company that they meet those requirements, that the insurance company would have 90 days to come and verify it. Things like that. Otherwise, it seems like the rewards for mitigation will tend to get bogged down. So that's what I was interested in is will there be some kind of regulations that will formalize that a bit more to because if you want to encourage homeowners to actually do these things, then there needs to be clear rewards so that it's a win-win for the homeowners and the insurance companies because we're all working together to reduce the amount of fire loss. So fair is fair.
No, no, I agree. And in a lot of these meetings, I get like we hear from owners saying, you know, we are doing all these things to get these insurance companies to continue writing policies or stay in California. What do we get back from these insurance companies essentially? These minimal discounts when this mitigation costs more and more and can be super expensive to take care of. What type of benefit are consumers getting? And here's the thing, it's like the benefit, I mean, frank, like as everyone knows, it's tough to even find insurance in today's market. And the main benefit or the main goal of like doing this mitigation is to even get an insurance policy in the first place. And even if somebody does all of this mitigation effort, does every part of the Safer from Wildfires, as I mentioned, the insurance company can still refuse to write that policy because they're not required to do that. But you're right. I mean, I will look into a little bit further to see if some of those changes about clearly defining discounts and requirements for those insurance companies, um, I can follow up with that as well.
Yeah, Lorna Moore asked a question in the chat. I'm not clear on Prop 103. If 103 limited increases to 7%, then how have insurance companies been able to increase their rates so much over the last couple of years?
Well, it's not that Prop 103 limits increases to 7%. It allows increases of 7% to go through without public hearing or to be up to appeal. So if an insurance carrier wants to go above and beyond that, which most insurance companies do, let me show you. Hold on, let me show you real quick. Um, so one of the earlier slides, you'll see. So one of the earlier slides that I had up, oops. So So you can see one of these earlier slides. Look at a little down here, American Family. They applied for 6.9%, 6.9%. Mercury applied for 7%. So when they go for 6.9%, 7%, as I mentioned, it doesn't go up to public review, and those will be automatically approved. But if they want to go beyond that, then that's where those rates are up for public hearing, and that's when we get third parties who are supposedly advocating on behalf of the consumer to dispute those, further delaying the process. And but in a lot of times those rates do end up getting approved. So yeah, it's not that Prop 103 limits the amount they can increase. It's more that kind of like it limits the amount that they can be approved automatically. I see. Is it possible for the Fire Safe Council to get a copy of the? Yeah, of course. I can. So I'll send you both. I'll send the Santa Barbara information separately. I'll just send you the whole presentation that Santa Barbara Association of Realtors had, so you can take a look at all of that data, which is pretty fantastic to tell you the truth. And I'll send you a um, separate one with the Department of Insurance presentation. And is that to K Furlong at sbfiresafecouncil.org?
Yes, please. Yeah, we do a lot of presentations all throughout the area, so that information I think would be great for all the other Firewise communities.
Oh yeah, absolutely. My pleasure. I'll definitely do that.
Thank you.
You're welcome.
There's a question from Anne Marie Parkinson. Do Department of Insurance representatives help homeowners understand if they are adequately covered or uninsured if they lose their home in a wildfire?
Yeah. So if you have questions about your policy, like interpreting it or making sure you've got the right coverage, definitely give us a call. Like we know that insurance and insurance policies can be complex. We have a whole team of insurance experts to be able to go over your policy with you to make sure you've got the right coverage for your needs. So let me post again in the chat the phone number. It is 800-927-4357. And yeah, they can go over your policy with you to make sure that you've got the proper coverage for your needs.
And Rob, I recall my family filed an appeal it was nationwide at the time, and that your office was helpful with some links, about how to do that. And so I wanted to just call that, if that's still true, call that to folks' attention. And my understanding is that kind of is dual purpose because it also informs you about what's going on, right? So that the commissioner can be informed about what's going on in the market and work on these issues on a macro level, as
Yeah.
well as kind of the consumer hotline level.
Yeah, definitely. I think there is a part of website. I'll find it and I'll send the link. But yeah, you're right. There's definitely a place on our website where you can submit that information.
There's a question from the Antonori family. We're not quite sure about rate increases. Our insurance more than doubled in 1 year. How is that within the rate increases you showed on your slide? And I'm not sure if that's the slide maybe showing by zip code. Um, uh, so I don't
So
know if Jim, if you're on, or Fran, if you wanted to say which slide in specific, but I would hazard a guess that like when you show 93105, it's true. A lot of us are, that's our zip code, but that goes down into town. And so some of those folks that are kind of flatlanders, so to speak, they're not in the hills, not in the high fire area, may have not had the increases that those of us have, up in the hills.
I think I know what they're referring to. It was actually probably the slide that I just shared. So let me share it again. So they were saying that um, you can see how these companies are asking for 28%, 12%, 39% or so forth, but it doesn't approach anything close to, as they had mentioned, a double in their increase. That's because those rate filing percentage is for their business across the whole state in all areas, not just for wildfire, for regular home insurance policies, for auto insurance, for annuities. Everything they provide is captured in those rate increases. And, you know, sure, and especially if you live in a high fire wild risk area, your rate increase is going to most likely going to increase a lot higher than somebody who's living in a lower wildfire risk property. So yeah, those increases aren't the number they use across the board. That's the average rate increase for their business on all their books across the state. Yeah, you're welcome. You're welcome.
Other questions? Otherwise, I have one, Rob, which is how can we all, it sounds like there's a lot brewing with the sustainable insurance options that the commissioner's pursuing. How do we best stay informed to know, like, for instance, that those did in fact pass and we're going to go into effect in January?
Sure. So the best thing to do is to sign up for the California Department of Insurance consumer alerts. This is where we release kind of press releases, information for consumers, some of these regulatory changes. Let me see if I could find the link, um, but yeah, that's probably the best place to stay informed. Um, Here, let me provide this.
While Rob's looking for that, if anybody else has questions, please put them in the chat or raise your hand. Because we're going to wrap up in just a few minutes, I think.
Okay, there it is. So yeah, register for the Department of Insurance subscription service, sign up for those consumer alerts, and kind of stay informed with what the progress of these regulations. But and also, like I said, I definitely encourage everyone to register for the hearing, the public hearing on Thursday. You'll hear both sides of the coin, to tell you the truth. You'll hear support of these regulations. You'll hear frankly some of the good points that the opposition has as well on some of these regulations. We definitely welcome your input and hope you can attend.
Great, thank you.
Mhm.
Any last questions for Rob? Let's see, I think there's one more here in the chat.
Yeah.
We weren't renewed by State Farm in September. If we're unable to get Fair Plan, where will we be able to get in line?
So for standard insurers in January, so I mean, definitely start making some calls. I mean, so typically when they give you the non-renewal, I think it's like give you like 75 days. I'm not sure. Actually, it might be close to 75 days. So definitely start making some calls. Typically, most homeowners can get on the fair plan provided they meet certain requirements, like they don't have pre-existing damages on their home or have liens or anything like that. But if for whatever reason they're still denying you coverage, um, I mentioned earlier how some of the most common insurance companies are called admitted carriers. There's also a whole market of what are called non-admitted or surplus insurance carriers that aren't don't fall under the Prop 103 regulations, but they're still licensed to do business in California. And a lot of these are still legit companies. One of the ones that gets mentioned a lot is Lloyd's of London, and they're still willing to write policies in those high risk areas. But because they don't fall under Prop 103, as somebody had mentioned earlier, they can raise those rates and increase it to the amounts that they want to without approval from the Department of Insurance. So it may be available to go with a non-admitted carrier, but it's going to be pretty expensive. But they're still a legit company. They still have solvency. There's some of the well-known names out there. Uh, they're still writing policies. You may have to dip into that market to find insurance. And then even if you do find an insurance policy, like I said, continue making calls, continue shopping around. Maybe start with Allstate, as I'd mentioned. They went on record earlier this year stating they would write policies across the state immediately. So maybe prioritize giving them a call. But yeah, definitely find out or definitely continue making calls. Coverage for 118K for 200, is that for the fair plan? Because yeah, I mean that's another issue with the fair plan is that it's pretty expensive for the amount of coverage you get. You're paying more for less coverage. Oh, for a non-admitted. Yeah, that's the thing. So like I said, they don't fall under Prop 103. They can charge whatever they want. They'll still write those policies unlike admitted carriers in California, but that's where the issue lies is it's available, but it's expensive. And again, that's our goal is to increase availability with those admitted carriers and hopefully bring those prices down through supply and demand, flood the market with insurance policies, drive demand down, which will hopefully decrease prices as well.
One other question I had, Rob, was that Fair Plan, as you stated, got overwhelmed. And I know they weren't even sending out renewal notices and amounts, and it was really hard to track them down. They were doing a big computer upgrade website, something like that. Did they catch up? How are they doing right now? I know there's changes that you're trying to work on to get folks out of that market, but in
Yeah.
the meantime, have they caught up with the growth on some level, at least to be responsive to the consumers?
Yeah, I believe so. I believe so. So, from what I understand, especially at that Realtor Association meeting I was at, they've talked about increased response time. They've been getting quotes a lot faster for insurance. especially when it comes to home buying and home selling, when time is of the essence. They some quotes are automatically approved that they meet certain thresholds. Customer service doesn't, you don't have to wait as long anymore. I believe the response times are less than 15 minutes now. So I believe it's getting a lot better as far as response time goes. So they are catching up. They've hired a lot more people. Like you said, they've transitioned to a new system. Still probably working out some kinks, but everything I've heard and what I've talked to with these communities, the fair plan is getting much better as a response than where we were at a year ago.
Great, thank you.
Yeah.
So we're at 9. Any last burning questions? Otherwise, I want to, there's some good chat going on, kind of folks advising each other and sharing information, which is great. But Rob, I really want to thank you for being here, especially late at night. And to everybody in the community that's joined us tonight. We did record, for those of you that joined after we started the meeting, we did record. We are still recording this presentation, and we will put it on the Mission Canyon Association website. Give us a week or so to do that. But please spread the word that it will be there. I think most of the folks that are here are Mission Canyon Association members, but if you're not, we encourage you to join. We need your voice. We do our best to represent different issues, especially around safety in the canyon. But it takes a lot of us. So really encourage you to do that. Want to give another shout out to the Fire Safe Council. That's one of the big changes that's happened in terms of keeping us all safe. There's been really great efforts there because they're now grant funded and have a staff, I think, of 5 or more. And Selden Edner, who's on the MCA board, is our community's representative on their board of directors. So we have a voice there, and they're doing great work. Really encourage you, if you're not in a Firewise community, to reach out to them to talk about joining one or creating one. It's a bit of a hassle. It takes a little bit of effort, but it's worth it, having co-led that effort in my own community. And it's reaping some rewards. And as Rob said, we hope it will reap more rewards in the future, in terms of getting ourselves back into a better insurance situation. So with that, looks like folks are just starting to thank you, Rob, in the chat.